at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts, Avinash Gorakshakar of Joindre Capital, Senthil Manikandan of Newberry Capital, and independent expert Shahina Mukadam join me on the show. Today on Hot Money, we'll discuss stocks like Crompton Greaves Power, which was down 30% yesterday but managed to move up almost 20% today. Bharat Forge and Motherson Sumi Auto anchors the space. What exactly is happening there? Bata is trading at new highs, posts the numbers, and a mid-cap stock that makes good investment bets. So that's something that we will be speaking on the show today. Let's start with the first stock, and that is CG Power. Now, the numbers came in day before after market hours, and the counter managed to correct 30%. The numbers was one thing. The other one was the issue of write-offs, that also, from affiliate companies. So there is a lot of issues that are there, apart not only on the P&L side but on the balance sheet side. What should one do with CG Power? It's managed to rebound. Would you take a bet on this, or would you avoid this counter? That's something that we'll ask. Avinash, what did you make? There are two aspects of CG's number: the P&L, the financials, and this balance sheet or items that they've done. How would you rate both of them, and what's your view of the company?
No, I think in terms of numbers on the profit and loss, the company posted a loss of almost 68 crores, and I think the power business did well, but the industrial business definitely lagged in terms of margins. And I think the bigger issue, Darshan, is on the balance sheet side. They have lent about 800 odd crores to a subsidiary, which has in fact lent to another subsidiary. And when now the recovery of that amount is in doubt, the auditors have qualified this item. And our sense is that, although provisions have been made partly for this investment, it looks quite surprising that, brand-related expenses have been charged for an industrial player. In fact, if it were a consumer company, one could have understood. But clearly, these are issues which most of the investors, especially the larger institutional investors, would not take it kindly. And I think what volatility you saw in the stock was largely also because of the fact that almost 100% of the promoter holding is pledged. So even on that count, on the conference call, nothing clearly was spelled out as to when this pledge would be, taken off. So all said and done, I think personally I would not like to make a bid at this level. I think it's better to wait for maybe 1 or 2 quarters and see how things pan out, both on the profit and loss and the balance sheet.
Now, what's your view on this royalty thing that they've done?
I think it doesn't seem to be, economically viable. The royalty has been reduced to 0.25%. Frankly, Darshan, I don't think, royalty is one issue which should have been actually been charged to the company. Largely because of the fact that it's not a consumer brand, it's an industrial brand where branding is not something which works in their favor. So I would believe that this is just a kind of a face-saving measure by the management. I would not be, so seriously taken by the fact that because the reduction in the royalty, that could be a compensation for the money lent to the subsidiary company. So I think the money given is quite significant. 800 odd crores is not a small amount.
Okay, that's the view that's coming on CG Power. Shahina, what did you make of the numbers, and what's your view on the company?
The numbers, of course, were pretty disappointing, and of course the write-offs that they have been taking right from the time the demergers happened in the last 1 year has really been very disappointing. The type of numbers, the quantum of write-offs that they're taking. Having said that, how I would view it is that after this big fall in the stock price, I would be looking at it in a positive way. The reason being that one is, of course, the management is trying to control its expenses. One of the moves, while you can debate whether it's good or bad and whether they should pay it, but I think the royalty number has come down. And in my view, the company does supply to industrial majors, global majors. So to an extent, the technology has to be upgraded. So it is I would say, if you're working, collaborating together with your partners and paying a small bit of royalty but getting that sort of technology, I see that as okay. Having said that, I think they have got a very big order position, a very big order book position, which in my view shows the capability and the potential that exists. An order book position of, I think, almost about 14,000 crores plus. So to that extent, they have not been executing it, it's flattish type of growth in terms of turnover that we are seeing, but there is a potential. I think the stock price correction has to an extent factored in all these issues. balance sheet and promoter pledge shares is a concern. But I think the current stock price may have factored in these negatives.
Okay. The second thing is that in the conference call they said that debt isn't down significantly. They managed to pull it down only marginally, and the sale of some of the international assets is again delayed. So is that a concern you would have, that they're not able to repair the balance sheet as soon as it should have?
Yeah, and actually the balance sheet post the demerger is like really looking has deteriorated. That's a very big concern, and the type of write-offs, like the quantum of write-offs that has been taken in the last 1 year is like very shocking. The receivables also, the way there doesn't seem to be an effort in sort of making that happen. Rather, there are such huge write-offs. So all these things are concerning, but I think the brand that they enjoy in the overall market in their segments is good, and if they're able to repair the balance sheet soon enough, I think that would be. Otherwise, the stock could be, the brand could be up for M&A activity. So at current levels, I think the stock has corrected enough in my view.
Okay, Senthil, what did you make of Crompton's numbers? What's your view ahead?
So at present you could avoid the stock because first only if you look at their consolidated operations, their international business are not doing well, and we have seen that since the demerger of since the selling of the consumer business, management was looking to sell out their Hungary business, but which has been postponed multiple times, and now they are given a timeline of April of this year. But even if you look at other operations within the Europe also, like Ireland and Belgium also closed down. So even if they revamp their operations over there, they have to provide for depreciation, which they haven't provided for so far. So I think standalone operations they are doing quite well, but the international operations are putting a large pain on their total consolidated numbers. And if you look at the recent quarter, they have like written off around 400 crores of loans given to a subsidiary on account of the royalty payment, decrease in royalty payment. But if you look at the debt on the books, is around 2,800 crores. But if the 400 crores has come in, I think it would have deleveraged the company somewhat and given a leeway. But now with huge debt on the books plus the promoter holding is also 100% pledge, I think these are the events that make us more cautious on the stock at present.
Okay, so it's a cautious view that's coming in. So that's the first stock that we want to talk about. Cautious view coming in on Crompton Greaves despite the counter, and it's been extremely volatile. So you need to be careful while trading in the counter. It's up almost 20% as of now. That's the view that's coming in on Crompton Greaves. Crompton CG Power as of now, it's moved up 19%. The second one is obviously we want to speak about the auto Inc space, and Motherson Sumi did disappoint. Bharat Forge came out with numbers yesterday, and that also disappointed. So there is enough negative traction that's there. What's the view ahead? Is Auto Inc a space that you should avoid given the weakness that we've seen in the domestic sales, or should you buy given the fact that these are all global companies and probably the potential in the overseas market is much higher? That's something we'll ask. So Shahina, what did you make of these two numbers? Is it worth getting into Auto Inc at this point of time, or is the global environment not conducive for investment in Auto Inc?
I think the numbers were better than what I had expected, really. For example, Bharat Forge with a decent revenue growth and especially driven by exports was a bit of a surprise, considering that there is a slowdown in the overall global scenario as far as auto and OEMs are concerned, and also industrials. So to an extent, I think it did pretty well. And even the EBITDA margins improving. So to an extent, I think the negativity that I had on both Motherson Sumi and Bharat Forge till now, I was in fact neutral to negative on both of them. I think is now starting to become neutral to positive for the longer term, because I believe that they have to be looked at as global companies. Indian operations, in my view, are becoming more and more insignificant for these two, but they have a very good presence even in the domestic market. And I think especially Bharat Forge has done very well in the export front in this quarter, and I see it as positive. And for Auto Ank, I think the next 2 to 3 years will be very exciting, considering that there is a change from to BS6. So I think to an extent there will be a nice demand pickup.
So would you invest in these stocks at this level, or you feel that there could be more pain before someone starts investing?
I would, as of now, I'm not really investing in these stocks as of now because of the sentiment of the overall market. My view on the overall market for the shorter term till elections is that we may see a bit of more correction. So in line with that, I think these stocks may correct or a bit more. So I think there is time to pick them up, but I definitely think it is on the radar.
Okay, what about you, Avinash? What did you make of the numbers, and what's your view on the auto ank industry?
No, I think broadly what Shahina said was right, that numbers were much better than what analysts expected, especially the EBITDA margins were within the guided range of around 28 to 29%. Clearly the management is hopeful that Q4 should be a much better quarter than Q3, but I think the bigger issue is on the domestic commercial vehicle side and the Class 8 truck market side. Both these segments have shown a negative trend since the last 2-3 months. My sense is, Darshan, we could possibly see some further pain at least for the next 3 to 4 months, and only beyond May, June, you could see some sort of a recovery. So despite the fact that longer term prospects look quite good, they have a well diversified base in defense, aerospace, as well as oil and gas. I would believe that the next 3 to 6 months could be challenging, and probably, one could see lower levels. Maybe at that time one could, accumulate.
Okay, and so at this time you won't recommend?
No, I wouldn't buy at these levels.
And what's your view on the Indian auto space as such? So because there is weakness that's there, these two are the global ones. But are you seeing more pain coming in the Indian auto space as such, which probably would reflect into weakness here?
I think clearly, auto component players who are largely attached to passenger car and the two-wheeler space. I think clearly these are segments which could underperform in the short term, and a lot of auto components stocks have already, corrected. But I would believe that the next 2 quarters, next 3 to 6 months are going to be more painful, considering that there has been a liquidity problem following the ILFS issue, and clearly volume numbers from larger players like Maruti have also taken a hit. So I would believe that across the board for two-wheelers and passenger cars, the auto component place should be avoided as of now.
Okay, what about you, Senthil? Are you recommending Bharat Forge or Motherson Sumi to any of your clients now?
Yes, I think both these stocks, after around 40% correction from the top, I think its valuations look reasonable. And first on the Bharat Forge, I think we have seen the major impact on the stock was because of the fall in Class 8 order intake. But if you look at the last 12 months, the order intake has been one of the second highest in the history. So the backlog at the production facilities are full. So that's the reason I think the order intake has fallen. And plus the deadline of the US-China trade talk, which comes in March, also puts some amount of delay in the order intake from the OEM side. So apart from that, I think if you look at the Bharat Forge, they have a diversified business lines, and their industrial business is doing quite good. And I think the pre-buying which happens before the BS6 emission norms should come in FY20. So that should provide some growth in the domestic level also. So valuations also on EV to EBITDA basis at around 13.5 times. It's look reasonable for a company which has net debt of just 1,400 crores and ROE or ROC of upwards of 25%. So, and on the Motherson Sumi, I think same like they have a diversified geographical presence, and if you look at the last 2 decades, for every 5-year plan they have given out, they have just achieved it. So this 5-year plan I think may get delayed by a year, because they have targeted around 18 billion of revenue sales. I think it may get delayed because of the macro situation that they are facing in Europe because of newer emission norms over there. Apart from that, I think the management focus on the bottom line, like they want to have a ROC of 40% across the entity level. So the focus on bottom line is there, and the valuations also, like from the 40 times PE, I think it has corrected to around 25 times. So for a strong management history over the last 2 decades, I think the valuations are reasonable.
Okay, that's the view that's coming in on Bharat Forge as well as Motherson Sumi. We'll move on to the next one, and that is Bata. Let's see what the counter is doing. Yesterday it was trading up by almost 5 to 6% the last time I checked. Let's see what Bata is doing. It's managed to stay at that level only, but the numbers were very, very strong. The management said that the festive season was extremely robust. They pulled out a new, there were a lot of celebrity endorsements that happened, a lot of new stores that happened. So that's something that boosted Bata this time around. 50% growth in profit, 16% top line growth is something that we saw on Bata. So what's the view on Bata? Will the rally continue? Senthil, you believe that Bata is in a sweet spot now, or now are valuations getting expensive for you?
So business wise, I think they have done well in Q3 because same store sales growth has come at around 10%. And even the future, I think they are targeting around 100 plus stores expansion every year. So I think business wise, they would do well. Plus their focus on the premium segment has given a huge margin accretion over the last 1 year. But like you mentioned, the valuations are not quite comfortable at this point of time because it's trading at around trailing 12 months at a PE of around 57 times. I think much of the positives have already factored in the stock.
Okay.
And I think the business has to continue at this level in order to maintain and sustain these valuations. So we remain neutral.
Will they be able to grow at this level going ahead? Is that something that you believe can happen, or is that a concern that you have?
So the valuations have baked in the growth prospects at this level. So we expect over the next at least 2 to 3 years their earnings growth will be around 18 to 20%. So now if you look at the valuations, it's trading the PEG ratio of 2 times. So which is not quite attractive, or I could say it's trading at a higher valuation.
Okay. What about you, Shahina? Bata, what's the view?
I am positive, and I just think that yeah, with a doubling of the stock from almost 700 levels to it touched almost double those levels before correcting a bit. So I think in a year's time, if that sort of rally happens, then you cannot really extrapolate it in the shorter term. But I still would be a buyer in the stock at corrections. The reason being that my expectation for growth in terms of earnings is much higher than the street expectations.
Okay.
I think what they have shown in this let's say quarter, in this last couple of months, is basically a potential to show a 30% plus type of earnings growth over the next 2 years.
Okay.
This is going to be driven in my view by 2 factors. One is, if you see the store addition that they are doing, it has been pretty massive, and I would think that they would touch almost by in the next 6 months and odds, they would touch 1,500 stores.
Okay.
Plus I believe that they are developing their e-platform very well, and so they are targeting both these in a very strategic way. And also if you see the way they are spending in terms of marketing, in terms of advertising, the expectation is that from 40-50 crores of advertising spend, it will be almost 140-150 crores over the next 2 years. Plus if you see the type of products that they are offering, especially for women and other classes also, I think there is an improvement in quality as well as designs. I think all these factors will play very well for the stock. So, well, valuations are expensive. I would agree, valuations are expensive, but if I'm looking at a 30% type of growth and FY, and I see a P of about 30 times for FY20 earnings estimates, I think I look at a PEG of 1 actually over the next 1 year. So I would be buying the stock at dips.
Okay, what about you, Avinash? What's your view?
No, I think numbers were very strong. I think a very strong festive season, and I think I would also agree that on the valuation side, it's better to wait for some time. I think probably on some correction, the stock can definitely figure out in my portfolio, considering that it's a consumption kind of stock, and I think clearly in terms of margins and in terms of top line, we could see further positive surprises as we go forward. I think clearly even the fourth quarter is going to be a steady quarter, but hopefully the current year, that is FY20, should be a much better year. So I would prefer to buy it on corrections and believe that yes, the longer term story would definitely pan out well.
Okay, so that's the view that's coming in on Bata at this point of time. And finally, since a lot of mid caps and even some of the large caps, except for the top 10 Nifty counters, have corrected significantly, we are asking one mid cap or a certain large cap that can be accumulated at this level. which can be held on for in times where the market is extremely volatile. So Avinash, which stock have you recommended to your clients?
In fact, Darshan, we have recommended a stock called Orient Electric. Now, this company came into being after a demerger from Orient Paper, and this stock got listed last October. This company has been in the market for the last almost 30 years and is into basically the consumer electrical space. They make premium fans under the brand PSPO. They are into LED lighting as well as home appliances. I think last year they posted a pretty decent top line, 1600 crores top line and a bottom line of 65 crores, and the traction in the first 9 months has been pretty good. 22% top line growth aided by 79% growth in the EBITDA, and the profit after tax has turned 30 crores compared to 17 crores. So all numbers look good. The stock has been beaten down post the Q3 numbers, but our sense is that if one were to look at the consumer electrical space and look at valuations of Havells, Bajaj Electricals, or even a consumer Crompton Consumer, I think this stock definitely has the potential to give a decent risk reward over the next say 12 to 18 months. So valuations may appear a little stretched now, but looking at the next 12 to 18 months, I would definitely buy it for a long term.
What's the valuation it's trading at?
Now, based on FY20, it trades about 20 times.
20 times. And is there any debt on books? Is the promoter share?
I think debt is also reasonable. They have pretty good ROEs and return on capital employed of almost 30% return on equity, 25% return on capital employed. So the balance sheet also is pretty decent. And I think the kind of products they want to launch in the market, I think is definitely going to be the next trigger. I think they're clearly looking at a lot of new products within the fan segment.
But they're only present in fans.
They're present in fans, in LED lighting as well as home appliances. Okay. Fans is about 70%, LED lighting is about 15%, and the rest is home appliances and switchgears.
Okay, and the new appliances which they plan to get in, which are these? What are
These are basically tie-ups with some German company. In fact, recently they announced that they would be entering the home appliances segment, and this is one segment where they expect that the top line in the next 2 years could get a significant boost. So I think home appliances is going to be one area where they are seriously looking to monetize the revenue, considering that they've got a fairly good well spread geographical network of 4,000 dealers, a 1 lakh touch point retail outlet base. So I think clearly the company has a strong footing, and I would believe that given some time the stock should do well.
Okay, that's a view. Orient Electric is something that Avinash is talking about. Shahina, which is the stock that you've recommended to your clients?
I think the agri sector should do well, okay. Irrespective of which governments, they have no choice but to be positive on the overall segment. If we see the MSP prices are continuously increasing, so I think government policy for the agri sector is going to continue to remain positive irrespective. Secondly, Kaveri Seeds is my pick. One is because if you see the balance sheet, they've got a very strong balance sheet. There's cash on books of more than 500 crores, I would say, and it's got a very minimal type of debt. So balance sheet is strong. If you see the product portfolio, they have got one of the deepest. In fact, they are the market leaders in seeds. They are hybrid seeds, disease-resistant seeds, market leader in cotton seeds. Plus, they are expanding very strongly into veggie seeds, etc. So I think strong product portfolio. Also, if you look at the distribution network that they have set up, they have got over 15,000 distributors and dealers. So I think they have got the whole, the business chalked out very well. And in terms of valuation, it is pretty attractive. It's about 15 times multiple, which in my view is pretty good for a high growth sector.
What's the risk that, if someone is investing in this counter, what's the risk that they should watch out for in this stock?
I think drought or agri or the farmer pain. To that extent, I think so it's dependent on the rains. So so if rains are really bad and the farmers have to take huge losses, that does affect one season later. The government is trying to put in place certain insurance schemes and trying to work along with the farmers for direct transfers. All these things take time. So I think by the time, but at the same time, if we have a bad season in terms of rains, that would be a big negative.
Okay, and Senthil, which is the stock that you're talking about?
So we like Quisco. The first reason could be like if you look at across their business segments, they have a long runway. The major business is their people staffing business. If you look at general staffing across India, the penetration is just like 0.5%. So even it is just 50% lower than the other emerging economies. So there is a long runway in their major business, which is the general staffing business. If you look at their newer segments like facilities management, even in there, I think the company has just a 1% market share, and it's like a 2.5 billion market. And the third segment is industrial management. Even there, I think you're looking, the trend is towards most of the companies are outsourcing their non-core segments. So I think this will be the trend in the future also. So across all their segments, there is a long runway. And if you look at their major focus now has been the cash flow generation. So so far last 1 year the margins have been reduced because their inorganic ventures has been in the consolidation phase. Like last year they acquired Monster, their internet platform. So that has been loss making. So but over the next 1 year, I think once they consolidate all these inorganic opportunities, and even on their consolidated level, their operating cash flow to EBITDA conversion also like looks comfortable, because from a 25% kind of range 2 years back, now it's around 45%. So they will be getting additional source of money to focus on newer opportunities also. So being a large organized player across all these segments, I think over the next, at least it's a long-term bet on the transfer of market share from the unorganized to organized, plus also the entire market expands.
Okay, the counter has corrected significantly from the highs. Any concern on the management as such, or the business as such?
So the main reason was that the fall in EBITDA margins, because over the last 1 year, if you see, they have been doing it around 6%, has fallen to around 5.5%. So they operate on a thin margin. So a small percentage of 30-40 bips can drastically impact the PAT level. And their latest acquisitions like Monster, which has been loss making at the operating level. So it takes time to consolidate these newly acquired companies. So that's the reason. So but when you look at a 3-5 year time period, I think they have done quite well in the past. Like they acquired the facility management Avion, and their margins when they acquired for the facility management concerns around 1.5%, but now it does around 5%. So they have a history of turning around companies and doing it. So we remain comfortable on the management and also the business.
Okay, so those are the 3 stocks that you need to watch out for: Orient Electric, as well as Quest Corp, as well as Kaveri Seeds. These are the stocks that's been spoken about. But with that, it's a wrap on this edition of Hot Money. Many thanks to all of my guests. Avinash, thank you so much for coming in. Shahina, Senthil, thank you so much for coming into the show. Ask BQ comes up next. Stay tuned to Bloomberg Quint.